Good morning. My name is Scott Redler, Chief Strategic Officer at T3Live.com.
And I'm Brittany Umar, and together we bring you Morning Call. We're seeing mixed markets around the world as Europe reversed hard off two-month lows, and Asia struggles to find its footing after weaker PMI. So a little unusual, Scott, that we haven't been able to find support there. What level does it need to hold?
Well, Asia, I think a lot of us have been looking at for 2014. The question is, what type of corrective phase are you going to have? And at this point, it's getting to that point where it should hold. You look at the FXI, you look at the chart, we've looked at this many times, and this has been the most recent move. And if you look here, you'll see this was, the double bottom over the summer. There was one move up, and it got a little wishy-washy on this corrective phase also before screaming higher. So now it pretty much retested this area. So I would say I'd like to see the FXI hold, above just say at least what is this? This is the 50-day moving average, which is 37.39. And if you did not get any exposure to this, I think this 37.50 would be an area. If you look at Japan, which was also down last night, it too, this entire year, this was that May 22nd high after a huge move. Here was your low. And it's still trending higher. Take out this one outside day, it's almost an aberration. You look here, it looks as if this is your spot. If you were looking to buy a dip and you believe that Japan and China are going to be higher next year, this is a spot to probably buy a little bit, not a lot, and then as it starts to get in motion to the upside, you get your confirmation. So, the FXI and the EWJ, if you're looking for a little exposure and you don't have any, I would go with a small feeler in both those support zones.
Well, speaking of last night, our markets had a bit of a roller coaster ride last night. We seem to be taking a cue from Europe as we look to be opening up about 8 to 10 handles this morning. And of course, we have the Fed looming ahead of us this week. So how do you think we handle things?
It's a little frustrating last night after Homeland, which was a great episode. A lot of people all over Twitter were like, oh my goodness, the futures are down 10 handles. Look what happened with China. And then you wake up today at 4:45 and you see them up 7-8 handles, and now I think they're up 10. So they're not really giving you that easy entry. I know in the latter part of last week I tried to re-enter some of my I was away, so I wanted to get involved in some of the the SPX or the spiders. And if you look here, they were coming in, but they were pretty lethargic. Okay, you want to take a look at different types of trends here. This was, the big trend that we've been following since November, which we're very extended from. So you didn't want to start too early or wanted some kind of signal because you still had a lot of time between now and Wednesday. But you take a closer look, this was pretty much when I was looking to take some risk down right when we broke the 8-day. We're 4 or 5 days down. Here is last week's low of 1772. And now it seems like we're going to be knocking on the door of this 2-day resistance. So with that being said, if we get above this 1782 with a 30-minute close or so, the next spot will be somewhere closer to 1796. And I would think the bears or the sellers want to maintain control, or which little control that they have here. 1796 this week will be that little rubber match spot.
Well, let's turn the spotlight to social media because it was the place to be last week. If you remember, last week we talked about Twitter and Facebook and the race to 50. They both got there in their own way. Let's start with Facebook. Relative strength again on Friday, closed the day up almost 3%.
Yeah, that race feels like it was last year, and it was only last week.
Right.
That just goes to show you that you have to be prepared. And if you look at Facebook, which has been something we've been focusing on the majority of this year, the most recent pattern that we were looking at is right here on the chart. You look at this red dog reversal. Remember that one at 44.04? That was when this recent decline changed. Okay, and what made it even more important was when you saw it change and then you saw commitment to it. You talked about this inside 3-day move to just get resolved to the upside, another sideways, upside, and here you are. So with that being said, 53.50 is Friday's high. This is the prior high. Sometimes you get some resistance there, so you want to see how it handles this. Sometimes it pushes through and fails. Sometimes it powers and closes above, which keeps everyone trapped. But just know that this spot is a little bit trickier than some others, and it's been a heck of a move. And if you always want to trim some into strength, it's fine. But if you trim and trail yourself out of all good positions like I did with this one, then don't cry if it goes higher.
Right. Well, a lot of people are crying about Twitter going higher. I think that was a tough call for a lot of people. I mean, forget 50. It left 50 in the dust. It's almost at 60.
Yes, I don't think anyone was really looking for this move. I think most analysts downgraded this when it was still in the low 40s, saying, oh, it's going to be in the 30s, blah, blah, blah. PS, the chart told you a different story. It didn't look that way until it started to go. And if you look here, we isolated how first, you saw this false breakdown right here. So if you were looking to get short, it made a little sense right here. But once it came back and reclaimed that and triggered above 42, that should have been your spot to cover if you're not committed to it. But if you're using opinions, that's a different story. Then if you had this quick move up, And if you missed that, you had an inside range, very, very tight. This was your trigger here at around 46.35. And then when it took out the prior IPO highs, that's another TBA. And then look where we are now. So with that said, I think it was downgraded twice today. Very, very extended. Some traders probably got hurt a little bit into this pain trade. Same way you never want to catch a falling knife. You don't want to just start shorting a top. You want to do a level versus a level. So this is Friday's level. I don't know if they're going to have enough strength to bring this positive today, but if they happen to bring it through 59.41 and it goes again, that could produce, a quick squeeze. And if it comes back below it, that's your pivot as a red dog reversal. If it opens up down, which it is, and then futures going and can't rally, and you're still looking for that cute short, then do it versus this high here, and then perhaps you see some of that sideways action, and you have some support at 56, and then you have support down here near the 8-day. People would love a move like that lower, but you never know. And these things are in the pain trade. They're fast and furious. So just know your time frame and know your risk, and hopefully you didn't have an opinion and get too squeezed there.
Right. Well, while not quite the exciting action that we've seen in Twitter and Facebook, Yelp has been holding higher. What potential setup do you see here?
This one also looks good. That and LinkedIn, they gave you some nice trades in the last week or two, but they're both still, not as on the radar as some of the others.
Right.
But if you look here, it looks like there could be opportunities. I know Sperling's been focusing on this. This was a nice trade here in this lower level. That was a nice wide range bar, and it's, markets pulled in and it held above it. So with that being said, I guess there's another trade here. If it can get above and stay above, just say the 66, and then perhaps it can go higher. Just be careful. This one's very thin, and lots of green bars get met by red ones, and it tends to be pretty random. But overall, Yelp's had an unbelievable year. You look at the move it's had. That's why I guess it's wishy-washy around here. So that is your pivot, and if you're playing for a move above that, only stay with it if it closes above that.
All right, well, coming up, we're going to go in the trenches checking the temperature of all the sectors. First, a quick commercial break. We'll be right back.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
We're back and going in the trenches, checking the temperature of the various sectors. It's important to do, especially as we have the Fed coming up on Wednesday, Scott. And we didn't totally get into what your expectations are this week.
Well, I think that they're going to. A lot of people don't think they're going to do it in December, and I would say the odds are they probably won't. But people want at least very, very strong language that they're going to start reducing the pace of purchase in January.
Right. Okay,
could be March. March is still fine, but and if they surprise and do December, I still think the market might have a knee-jerk down, but we'll like it much better than if we have the September surprise where they start with the language that they're going to keep a common data for all 2014, etc.
Right.
So with that being said, I think that the market wants good news to be good news. Let's hope that the data continues to incrementally go up, and then I think the Fed will continue to get their foot off the pedal. And they have a setup here. It's December, so some are thinking, why would they do something this month and mess with the bond market, and people are away and volumes are light. So that could be the reason why perhaps they give you the strong language but don't do anything until January when everyone's at their desk. But I'll be prepared for both. So it'll be good to look at where the sectors are and get some clues from the market action versus everyone's opinions.
Right. So when we're talking about watching for clues about the market's direction, one of the groups we like to watch is the financials. Yes,
and Monday lethargic. Anyway, the financials, they've been pretty much controlled pullback the same way as the S&P. So there's not much we can get from there now except for, it's holding up well, it's testing a prior level. You go to the XLFs, you will see that, overall this was the trend from November, and this was your last prior breakout, and we're sitting right on there. So with that being said, you take a closer look here. If you happen to have sold some of your holdings when they couldn't break above this recent resistance right around here, then maybe you look to see if it can come back. So for the XLFs today, if it can get above 21.23 and stay above it, you can almost make this a bigger flag type pattern. And then the longer it stays in this upper range above the prior breakout, perhaps we get another move to highs, and it could be Christmas, it could be 2014, we shall see. But right now, here's your low to trade against, which is 2106.
We also like to look at the Russell for clues about market direction, and the ETF, the IWM, has been repairing some losses and managed to close in the green on Friday, so that's a good sign there.
Yeah, and as I was in Florida, I was actually looking at the Russell. I'm like, oh, the Russell is trying to regroup and get back above the 50-day. So I kept trying to buy the spiders, and that didn't work. But anyway, that was some clues to at least cover some shorts.
Right.
And if you look at the Russell, this is already at the trend line, so it's been weaker. You know, this trend that was intact since November, test, it basically is testing the trend line when most of the other sectors are just testing their prior breakout level. So right here, this was like a prior breakout. So some other sectors are like right around here where this is on the trend line. So with that being said, it's definitely worth watching to see if they sell this early. As of right now, it feels as if it's going to open above, you know, this little pivot. And then I think for the bears to maintain control, they're not going to want to give back like 11.55. And then you have a trend that's coming in right around there. So this is your bounce back area. That's where the sellers going to have to maintain control. But, you know, so we'll see what happens with this week.
How about the Qs? We just had a 3-day pullback there into the 21-day EMA. Do you think that they'll continue to find support there?
That's a spot. You know, this is, well, the market went below the 21-day and then went to this a little relative strength. So again, like I think December has just been that month of divergences, that even within the Qs, stocks are diverging everywhere. So you can't read too much into it. You look here at the Qs and you'll see that, you know, at this point he had this wide range bar after breaking this upper level. Okay, now it's right back into support at the 21-day. See if it can get back above this and then negate half of the potency of that day, which was, I believe, mid last week. So that level right here is 85.40. But then if you look overall, this trend that's been intact since November, it's so far above. So it's just like, it's just a little hard to handle unless you're just going to sit, close your eyes and say, you know, this market can be higher. And I do believe that, you know, the Qs will be a good spot to be in for 2014, just may not have the sizable gains like we've seen this year.
Right. Well, what about consumer staples? Because we did see the XLP show some relative strength on Thursday and Friday, especially on Friday when it was able to bounce and close well off its lows.
This one's not testing trendline support, it's testing its breakout. So it's, you know, showing a little strength.
Right.
You look here at the XLP, you know, you'll see that this was your last move off of the bottom of this channel. Happened pretty fast and furious. A little bit of follow through, right back down into the prior breakout. So I would say at this point, you know, you have 42 as the area to trade against. This is where it broke down from. So you want to see what type of bounce. Is it sold and rejected, or does it continue to the upside? And then at some point, you know, you'll have to know where this resistance is. And you know, this group is showing relative strength versus some others. So I think you could stay with it if you like this area.
Would you go so far as to call it a place to be?
Not for me. The market will be up. I'm like, where's the money? It'll be there in the consumer staples, and I'll probably be a little frustrated because I just don't watch that many names.
Right. Well, we'll keep an eye on it in the coming sessions. But how about let's do some quick hits and talk Apple. Apple was upgraded on Friday. We still saw some weakness there, and it did close on the lows, so that signals some potential downside follow through today. Yeah,
I know like some of my traders they might have went home short Apple on Thursday because it looked like it was going to break that upper level. Got upgraded, it was up 4. And then all of a sudden, I think, on the beach with my son. I'm like, ooh, it went from up 4 to down 3.
Right.
Hopefully they saw that relative weakness because you never, you know, it's really, I would say it's not the strongest sign when a stock is up on an upgrade and then reverses and takes out a level. And if you look at the chart here of Apple, that's what it did. You know, it's had a heck of a move since the summer lows. You know, this was a nice buyable area, another nice buyable area, and then you come into this upper wedge right here, and this is what a lot of guys are trading against. What is 559? Opened up, broke it, so that was probably a decent short for some. You know, I don't know if they took it home or whatnot, but if you did, you know, they're probably going to say, okay, you know, let's see what happens here, because Jeffrey's now upgraded it. So like all the King's horses and all the King's men are coming in. But anyway, with that being said, in order for the pressure to be relieved and for me to start thinking it could be an A+ setup for upside again, let's get it closed back above this 559 to 562. If they sell the market a little bit and Apple goes from positive to negative. If it were to trade through 553.67, you could see a move to the 21-day, and that 21-day for me would be a good spot. I have no Apple right now, so I'll figure out. I'd like to get involved in it because I do think it is buyable, and this high here will not be the high throughout January, but we shall see.
What about Google? Because we've been seeing some profit taking there over the last 3 sessions or so, and the stock dropped below its 8-day on Friday. Now we have the news of its new robotics. So do you think it could see the 21-day, or maybe that news will be enough to lift it?
This was on my radar to come in. If we had a negative open, I was looking for a reversal on Google. Now it's probably up, so it's going to be a little tricky. So with that said, you look at the chart here. Our chart still looks good. Gave up the 8-day. This small little trend line got breached. So we'll see real quickly if we can get back above it. I was hoping to be able to buy it around the 21-day or use some type of red dog reversal with Friday's low of 1,057, but what I hope for doesn't mean it has to happen in the market. So with that said, use like a 5 to 15-minute chart. If the gap up holds, perhaps try and get a feeler, and then if at some point it starts taking out 1,076-ish, it can get back on its game for what could be a move to above 1,100, in the first quarter of 2014.
All right, how about Netflix? Netflix had a rally on Thursday, but then retraced about 1.2% on Friday. So which way does it look poised to go Monday?
I would just say stay with it as long as it stays above the 8-day. And if there happens to be a setup, take the setup. I do not see a setup right here in Netflix. You look at the chart, every now and then we get excited about it when it's pent up and it can get above like a key area. Happened here, also somewhat happened here. And now, I'd say it's going to be hard because the futures are up, it closed in the low. Some might even try and fade it because it was weaker on Friday. But with that being said, really this 8 and 21-day has been the trend to follow until that changes. Don't change your standings on Netflix. And
Amazon got tired on Friday too, had a nice rally on Friday morning, but then gave back most of its intraday gains and closed on the lows. So again, a warning sign. We could see potential downside follow through today.
You know what, this too, it's just been very choppy, random type of action within all of these high beta names. So it's either you're in them and you're not worried, or you're trying to play them on a smaller time frame. And if you look here at Amazon, I'm sure, just thinking about it, guys are probably looking for a breakout above this area. And then what happened? It failed, closing the lows. So some probably are taking this home short because oh, look, it failed right here. Now the futures are up, so they might be trapped. So all in all, not the easiest trade here in some of these names, but still in this channel, still going sideways until you get a really potent one to the upside and close above. I would stay kind of neutral, same way on the downside, but all in all, above the 8, above the 21-day, really on the more intermediate macro time frame, look at the move that this Amazon has had. If you've been an investor in Amazon, you've been rewarded.
Very true. Well, how will you be approaching the trading session then today?
Well, I've reduced a lot of my risk when we broke the 8-day. I also went on vacation to a wedding on Thursday, so I had all my risk down. I thought things would be perfect. I'd come in, futures down 10 handles. I can put on 7 to 9 of my favorite stocks again and figure it out. But now we're up 10 handles, so the last thing I want to do is buy it up here and then it's a fade. But it seems like it's got a little bit of the ingredients for a gap and go. So with that being said, I'm going to remain tactical because tactical has been somewhat good to do in December because you are getting good trades from the long side, the short side. So for me, I'm going to try and keep my stress down. We also still have the Fed on Wednesday, so there could be a lot of volatility to give you some entries depending on what they say. I'm hoping the language is strong, the pace of purchase is reduced. If it happens to be December, you could get a quick little reflex down, which I think could be buyable. If it's just a strong language, I think we can get a lot of the same. But overall, if you happen to have risk down and you see this gap up, don't be too stressed. Figure out a way in on some of the key stocks. If you're in things that you've been in all year and you're trading around them with a tier 1 looking for a tier 2, use that same method. But overall, I don't think you're missing anything. This week's going to have a lot of opportunity, and don't start it off on the wrong foot.
There you go. And happy trading, everyone, and have a great day.